Okay, so let's get a little bit more granular on the topic of risk management and some of the more important considerations prior to entering a trade. And there's 4 things I'd like to talk about. Number 1, does it fit the parameters of the strategy? Number 2, knowing the risk-reward profile of the trade. Number 3 is the probability of winning. And number 4 is the worst-case scenario and a contingency plan. So first off, does the trade fit the parameters of the strategy? Is this a trade that you would normally take? Or are you taking the trade because you're impatient, you're bored, and you're trying to force something when you really should be doing nothing? Remember, patience is the key with trading. Sometimes the best thing to do is to not trade at all. Remember, there's the gift of being flat. It can be a wonderful thing. Not being in the market can be very liberating. When things move and people are screaming in pain and you've got none of that pain and you're just waiting for the right opportunity, it's a wonderful thing. So let's just say that you're selling in volatility. You're really, really impatient and you're selling some volatility when volatility is low. You might get away with it. And hopefully if you're doing so, there's nothing necessarily wrong with doing it as long as you're doing it in very reduced size and you have very tight risk parameters. But if that underlying asset makes a significant move against you, you're going to feel the pain. But if you are patient, you are flat, and you are waiting, you can let that move happen, or at least a bulk of the move, because we don't know the entirety of the move, because we don't know what the market's going to do. Let that vol rise, then you're going to be in a pretty good position from the person who took a position early because they just felt like doing something. Being flat or very limited exposure is zen, okay? And some other things we can kind of file under this category are overtrading, revenge trading, and trading during economic events. Hey, we've all been guilty of overtrading. We get exuberant or we get angry or revenge trading. We're trading too much. It happens. It happens to everyone. And never underestimate the power of an economic event. Fed meetings, different CPI, different news events coming out. They can have significant effects on the market and volatility. So if you're unsure, stay flat. Stay flat. Let that move happen. Let all the craziness happen, then come in after the fact. Now, overtrading, I'd say it's probably one of the most common things that people do. It's easy to do. Similar to trading when you're bored. You're sitting there, oh man, I really want to earn some money. I need to get some theta going. And it's okay with doing that a little bit as long as we're limiting our risk and we're doing it in very, very small size, as I mentioned before. But overtrading is one of those things that kind of creeps up on you. You end up doing a little bit more. Next thing you know, 3 weeks down the road, you've got positions up the yin yang. Oh man, and if things start to move against you, it's hard to understand how all these different positions are affecting you. And it makes your job a little bit harder. And not only that, you can rack up a lot of fees doing so. You can really start paying a lot of fees. And those fees don't seem like much sometimes at the time, but at the end of the year, they can really, really add up. So it's important to let the trades you have on, cook, so to speak. That's what we're doing. When we're selling volatility, which is what this course is about, we have to let those trades sit. We have to let that time decay eat away at it. And doing so means just sitting on our hands sometimes and waiting. So we don't want to overtrade. We don't want to have all kinds of positions all over the place. It's just going to complicate our lives and make it difficult to hedge off risk. And on the subject of revenge trading, it's instinctive in a lot of people. You take a big hit. You desperately want to make that money back. I get it. I've been there. It's hard to resist. But regardless of that trade or your last trade, your next trade must fit into the proper parameters. It can't have anything to do with the crappy trade before it or the successful trade before it. Remember, we want to be like machines, right? Like Terminators. No emotion whatsoever. Going bigger or harder to make up for a bad mistake or a bad trade is usually just going to compound your problems. Case in point, one of the accounts I manage happened to have a big hit in Bitcoin. I got burned on some puts when Bitcoin got cut in half. Now the problem was yes, I would have taken a decent hit on some of these naked puts that I had, but that wasn't the worst of it. The worst of it is at the time, the market completely disappeared. I was not able to exit those trades. I couldn't even take the loss. I had to sit there for almost 4 days until enough of a market came in where I could start scaling out of my loss. It was frustrating as hell, and I lost half the account. But what did I do? I didn't go hard the next trade. The next month, the next 2 months, I said, well, if it takes me 2 months, if it takes me 6 months, if it takes me 2 years, I will make all that back, but I'll do it properly. I'll stick to my system. Every trade is just going to be ding, 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 methodical, all fitting my parameters, all fitting probability, and I will get that money back. Most people don't take that approach. I didn't used to when I was beginning trading. I would have swung for the fences, and that would have compounded my problems. Sometimes these things happen, and there's not much we can do to control them. News events, all kinds of things. All we can do is stick to our risk parameters, stick to our rules, and let probability work out for us. And finally, being aware of really major economic or key economic events is very, very important. OPEC meetings, Fed meetings, etc. Don't underestimate the power of these events to significantly move the market. Again, the gift of being flat can truly be a gift, especially during those times of potential extreme volatility. Let the market make their dramatic move and scare the shit out of everyone. Let the IV shoot through the roof. Then we come in and we'll sell that premium. Probability is much more in our favor when the bulk of the move has been exhausted. Because let me tell you, it's no fun being on the wrong side of a massive move. So let's avoid it and then take advantage of it when we can. So number 2 is knowing that risk-reward profile prior to entering a trade, not after you've entered a trade, but prior to entering a trade. So for example, if one was to sell a really low delta option, sure, the odds of that trade going against you are extremely slim. You're almost guaranteed to keep all that premium, but you're receiving peanuts. You're receiving a tiny little bit for what could end up being a whopping loss. It's simply not worth it. It's a rookie mistake. They see this money there. It looks like free money, and it almost is free money. But that 1 in 1,000 chance that thing goes against you, man, it's going to go against you hard, and it's going to slam you. It is not worth it. So the risk of a particular trade might be that you're risking $2 to make $1. That can be just fine, no problem, if probability is on your side. And we know over time, probability will play to our advantage. So knowing how much you can make versus how much you can lose on any given trade prior to entry is absolutely mandatory. Never forget that while we can reduce risk in trading, we can't eliminate it altogether. There's always going to be some amount of risk. Just like when you drive a car, you can reduce your risk by following the rules of the road, having a well-maintained car, wearing your seatbelt, but you can't completely eliminate the risk of driving. So with this, we want to know, what's the worst case scenario? What's the worst case loss? How much is that? And can we afford that worst case loss? Is it within your quote unquote set of rules? So for example, a very popular rule is that no one position would represent a max loss opportunity more than 2% of the entire portfolio. Great, stick to that. And so where is your stop loss or the point? Will you either cut or manage that trade? This is where you must be disciplined. You can't deviate from your rules. Not just once. As I mentioned in the previous video, you deviate just once and you've learned a very bad lesson from the market, because I guarantee you'll do it again. If there's no punishment, you'll do it again. So don't put yourself in that position. So if your rule is that you'll cut or you'll manage a position on, let's say, a short vertical spread, when the market hits your short strike, then do that, or as close to it as possible. For a long position, you might have a rule that says, hey, if the trade goes 50% against me, I'm out. Clearly I was wrong, I'm out. Just stick to whatever your rules are. Remember, we don't want any one trade to destroy our account or to seriously disable or hobble our account. We should be able to survive a string of losses. Even though they're unlikely, it can happen. We want to be able to survive that. Like I said, each small loss is like a slap in the face. You can slap me in the face all day long, but you can't beat me down all day long because you won't have an account. And if you're trading multiple assets and multiple strategies, be aware whether or not you're diversified. So if you're long delta everything under the sun, you're long delta, long delta. Well, if the market drops, guess what? You're going to feel the pain almost everywhere, and that can be absolutely devastating. It's worth it to keep an eye on that delta, take a step back from time to time, and ask yourself, what is that worst case scenario? If it looks pretty crappy, then you should probably make some adjustments. Now, you've heard me say before that rogue traders try not to ever utilize any more than 30% of the margin of their account. This is important because it gives us some wiggle room in the event that things don't go our way, and sometimes they're not just going to go our way. It allows us to manage the trades that need to be managed and take advantage of opportunities that may arise. It is absolutely no fun sitting there handcuffed, unable to take any action whatsoever except just sitting, waiting, and praying. And that's no strategy at all. And eventually you'll get burned by it. So part of this is also ensuring that you have the right position size. If you've loaded up well beyond what you should be trading, well, it doesn't take too much of a market move to trigger all your stops and to put you under extreme duress. You need to trade an appropriate size in accordance with your risk reward. And you can't fudge these rules, not even once. If you do it, and I've said it before, you do it and no harm comes to you, you've just been taught a really bad lesson from the market, because I guarantee it'll happen again. You'll be more and more apt to break that rule, and one of these times you will get hammered. Trust me, I have been there. So we take care of risk, and profit will take care of us. Remember, if you lose 10%, you need to make 11% to recover. If you lose 25%, you need to make 33% to recover. If you lose 50%, you need to make 100% to recover. So you can't let losses get away from you. Just don't do it. It's one of the secrets to longevity in the market. So next up is the probability of winning. So a lot of different brokerage platforms out there, they have the POP, the percentage of profitability built in before you put on a strategy. It's very, very helpful. So you'll know right away what your percentage of winning that particular strategy will be before you put it on. But on a very, very basic level, if all we're doing is selling options on a very limited basis, such as one strategy at a time, let's assume we're selling vertical spreads. We know our probability by looking at the delta of the short strike. If we're selling a 0.25 delta call option, at that moment the market is giving us a 75% chance of being right, i.e. that option expiring out of the money, which is what we'd want. So there's not much to it in that case in terms of probability of winning. But when we start to lay on more complex strategies, it's actually nice to have the software calculate everything for us, spit out that POP, saving you some mental gymnastics. So prior to executing any trade, we'll always make sure that the odds favor us. Sure, those odds are going to swing around from minute to minute, day to day, week to week, but over time, that probability number will end up being extremely accurate. So number 4, what's the worst case scenario and what's your plan? What's your contingency plan to deal with that? Now, every single trade, and I mean every single trade I put on, I assume that everything's going to go horribly wrong. I never assume it's going to go right. Why? Well, first off, because from time to time things will go horribly wrong. That's life. That's trading. But most importantly, when we make the assumption that things will go wrong, it forces us to have a contingency plan, or at least a pretty damn good idea of how we're going to manage that position. You don't want to be a deer caught in the headlights the occasional time that something really goes awry and you're like, oh, panicking, I don't know what to do. Well, you know what to do, because when you got into that trade, you had that contingency plan in place. You had a plan that if things went horribly wrong, this is what you'll do. And you can execute on that plan. Doing everything as a limited risk strategy is a great first step, because no matter how shell-shocked you might be with a dramatic market move, you know that you have limited risk and a maximum amount you can lose. So you can rest easy. This allows you to breathe a little bit and get to the task of taking whatever actions are necessary in managing that trade. But knowing what you'll do to manage that trade in the event of a worst case scenario is crucial. So first, it gives you an actual plan to follow, which is nice. You don't have to think of something off the spot, right? You have that confidence of having a plan ready to go, ready to execute. Remember, we want to be robotic. And as traders, we want to be completely impartial and unemotional. Knowing in advance and having that plan in place really helps with that. And as part of that contingency plan, you'll need to know your break even for any given trade and the trigger points at which you will execute and get out or manage the trade. So trigger points and a break even analysis. If a trade doesn't go your way, you need to know first of all where your break even is and where your trigger points are. So for example, if you're putting on a vertical credit spread, are your personal rules that you'll either close or manage that trade if your short strike is pierced? Or will you take action when it hits your break even? These are personal choices. It's just important, and I've said it 1,000 times, you stick to it. Now, I do recognize that things will get away from you from time to time, especially if you're trading crypto, because they trade 24/7. It does happen. You can wake up in the morning and it blew right through where your stops were. Okay, we'll just deal with it. We know it's limited risk, so you can rest easy on that. Doesn't matter how much further it goes against you. You've lost the maximum amount you can lose, and we can make a decision to close that trade or to manage that trade. And of course, where we can, in the markets where we're able to, we can put our stop orders in too, stop loss orders, which is very, very helpful. So if we're trading futures, for example, that's a great thing to do. I would never leave a naked position open. I'd always have stop losses in places or take profit in places. And if you stick with us as we go through more and more courses that we're offering, you'll see how we do that. The important thing to do is just do your absolute best to stick to your rules and recognize sometimes things will wiggle a little bit more than you would have liked them to. That's life, but keep them tight. That is the key to longevity as a trader.